You may want to sit closer. This thing keeps getting disconnected. I don't know why it is doing that. You tell me when you're ready. All right, everybody. I think we'll go ahead and get started. Appreciate you coming today. We're expecting about 20 people here in this room, and then we're also expecting about 20 people joining us through the webinar remotely today. So depending on how many people show up or turn out, but we can have up to 40 people today. We're looking forward to helping you guys get an understanding of the new tax law changes that took place about a year ago now, I guess, coming up on first part of December. Major legislation when Trump had control of the House and the Senate. Republicans were able to push through a bill that was the largest tax law change in about just over 30 years. 1986 was the last one. So from an accountant's point of view, a tax guy's point of view, pretty much all the rules, not all of them, but well over 50% of the rules changed. So we just want to take the time with you guys today and educate you on some of those changes. Try to give you guys a feel for how that's going to impact you. I don't think we'll have time today to necessarily dive into specific situations, but mostly our intent is to provide you with a good general overview of the changes that took place. And then, yeah, so we'll just kind of go from there. Today, we're basically going to talk about, well, not talk about, you're gonna hear from 3 presenters. You're gonna hear from Will Bryan. He'll talk first. And he has worked with us here at Davies Allen for Will. I think it's probably been about 7 years or so. He has his master's degree from the University of Utah, emphasis in taxation. And then Bryn Seaman, she's going to talk next. Bryn's been with us actually maybe a couple years longer than Will, so around 9 years we've worked together. And she is a CPA and has her master's degree from Utah State. And then you're going to hear from Dustin. And Dustin has his master's degree from SU. Deloitte in Las Vegas. And has about 7 years in experience in the industry as well. So wanted to just introduce you guys. Zach is running IT today. We're kind of having some issues with connecting. For some reason, the laptop keeps getting disconnected with the monitor, so he might have to run up here and kind of reconnect us and keep us going. So anyway, I think that's that. Does anybody have any questions about the format or what we're trying to accomplish today before we get started? You guys good to go? We have some snacks, some food over here, so feel free to help yourself. But let's go ahead and turn the time over to Will.
All right, so I will be that happened with the tax changes that happened in 2018. Changes that took place on the individual tax side of things are temporary as of 2025. So a lot of what we'll be talking about, that is the case. Another thing that was interesting, or that will be beneficial to all of us throughout this time, is that many of the changes that were made, they set it up so that the benefits are indexed for inflation. A lot of the old tax law was old and it never got updated for inflation, but the changes now are so that we are indexed for inflation. So, so JW asks, what's an example? One right off the top of my head, the estate tax exemption is one that's an index for inflation. So each year, there's other ones. A lot of the limits on 401k plans will change sometimes for inflation. So there's there's a lot of those, and we'll identify some of them as we go through because it will say. So in this, we obviously can't cover everything in this presentation, but we hope it'll affect you the most. For those that may be more interested in a detailed plan, we'd love to meet with you individually and do a tax projection and talk to you a little bit about planning for this year. So the first change we wanted to talk about is changes to the withholding tables. And this has been an interesting one for us as tax preparers because the government is the one that decides what that is. And in the beginning of the year, we were like, we got to trust the withholding tables that the government put out. But sorry. But what you need to know about them is that they were adjusted for the new law, and the IRS has recently warned that the adjustments made to the withholding tables may have caused some underwithholding for some taxpayers. So how does this affect you? If your main income is W-2 income and you're used to getting a big refund because you've had so much withheld from your paycheck, there may be a chance that you've been under withheld this year. So you could have a lower refund or maybe even owe. So if you are concerned about that, or if that fits your circumstance, we would love to help you look at that and see if that's a situation that you're in. And it's always good to know beforehand rather than being surprised in April. Moving on, the next big change that will affect everybody is the tax rates and brackets for individuals. Tax rates have been lowered and the brackets have been expanded. This will affect everyone in that. Hopefully it will help you pay less tax. So if you can look at the chart, you can see the comparison and how it's changed. The highest bracket went down from 39.6 to 37. And you can see that you don't hit that 37% until 600,000, whereas before it was 470. So, and all the way down the board, that's the case. If you look, you'll see that is the case for all people married, filing jointly, single, and head of household. Long-term capital gains rates were not necessarily changed under the new tax law. So there's no change compared to last year. The one change that there is to note, although most people wouldn't notice it, is just the brackets. The the brackets kind of stayed with the old tax law as far as when you switch to a higher rate. So, yeah.
I just want to make sure everybody. Let me borrow your thing. I just while we play around with this, while we play around with fixing this technology up here, I want you guys to realize that every bracket has, and it's not just the tax rates dropping, right? But it's also that the brackets are expanding. You guys know what we're talking about when we say the brackets are expanding. So in tax law, you're taxed on, say, the first $20,000 at 10%. And then you're taxed on, say, the next $80,000, and that's taxed at about 50. It used to be 15%, but now it's 12%. Okay, and then from there on, it's tiered. So the more you make, the more you pay at a higher rate. And so the important thing to understand is that I think as I've been meeting with clients about these brackets, they're kind of under the general understanding like, it's only a 2-3% rate. It's not going to affect me that much. But by the time you take the expanded brackets into place and you do the math, there's significant savings that our clients that we're seeing as we're generating these. Look, in particular, and I'll hand this back to Will now. I think we got this figured out, but I just wanted to show you, look at this one right here. It went from 25% down to 22%. And actually, I want to look at this one, 28 to 24. It used to end at 233. That's the taxable income where it used to end. Now it's ending at 315. So there's about $80,000 more of income that is now being taxed at 24%, whereas last year it would have been taxed at 33%. So it's not just the difference between the 28 down to the 24, but for that $80,000, it really went from 33 to 24. So it's a 9% difference in that situation. Does that make sense? All right. So you can move on, but I just thought I would point that out while I was trying to.
Thanks, JW. Sorry about that.
Maybe I was trying to get my computer going. Earlier, I thought it was a statement that maybe some people are going to end up owing more tax if they're a W-2 employee. How is that? Does that make sense? Like, how is that possible?
Yeah.
With the rates going down.
I feel like this is saying you're going to be maybe overdone.
So what happens is with your W-2, the IRS has withholding tables, and they say you make this much, so you should have this much withheld out of your check. Well, they adjusted those tables to match the new rates.
Oh, okay.
But when they did that, the adjustment wasn't necessarily correct, and they made it so that they weren't withholding enough. So not enough has been withheld. So yeah, over adjusted again.
My position in the company is HR director, and whenever people end up owing, they always look at me. Like, does that make sense? Or like, how bad is it going to be?
It's going to be on a case by case basis because there's so many other things that affect what they're going to owe in tax, and we'll go over some of these, like the standard deduction and sorry, I should be better about, but hopefully we can answer that question as we go along. So going on, the next kind of major change from a high level view is the estate and gift tax exemption. And basically what happened was that there's an exemption over your lifetime where you can pass you can pass your inheritance to your heirs tax-free, and the limit in that prior to 2018 was around 5 million. In 2018, it has doubled, so that exclusion has doubled to 11.2 million, which basically means all estates will be shielded from gift or estate tax. Doesn't mean there's not things you need to do to make sure proper succession is in place, but it's a good news for those who have something that they want to pass on. The next big change that has come, and this is one that will kind of address that question earlier about how big the change will be, is a change in the standard deduction. And basically across the board, the standard deduction was doubled. You can see here on the chart that the numbers from 2018 had the law not changed, and then with the new law, this is one of those things that will be indexed for inflation. So this will change every year, and it will also go away in 2025. The big question here is how will this affect you? I believe over 90% of people will, well, this will affect you in two different, it'll affect you, could affect you in two different ways. One, if you don't have enough to itemize, you'll be getting significantly more deduction on your taxes. And that will create the savings. The other way that it could help you is if you don't currently, or if you do currently itemize, but you're right on the edge of this itemized limit, you may be able to save additional tax by changing the timing of some of these deductions. And what we call that is bunching of itemized deductions. So some of the itemized deductions, like your charitable contributions and your state taxes, we may be able to move those payments all to be in 1 year and take the and itemize the deductions, and then in the next year take the standard deduction. And by bunching them all in 1 year, by changing the timing, you can benefit even more from the raise of the standard deduction.
So, Will, can you repeat who that strategy would be applicable to?
So over here, if you look on the chart, if your itemized deductions are around this, the limit here. So if you're married filing jointly, your itemized deductions are around 24,000. You know, you're right on that borderline, then it may be more effective to bunch those and have it 1 year on, 1 year off. The other thing that can be helpful is I know many of our clients who have come in for tax planning pay their kids a wage if they work in the sole proprietor business. And the standard deduction is kind of what bases the limit of what you can pay your kids and not have them have to file a tax return. And so normally it's been in that $6,000 range is where we if you're paying your kids, that limit has basically doubled. You can pay them a lot more if they're doing the work and it justifies, you know, paying them that much. The next big change that we have from the tax law change is exemptions have been eliminated for 2025. So there's no longer exemptions for, you know, the number of children that you have or other dependents. And this at first seems like a bad thing, but keep calm. They've done other things that will kind of make up for this. So basically, they kind of swapped this and the child tax credit. And I think in the end, most people will be benefited in a positive way. But those with children under 17 will probably benefit the most. And those who have dependents older than 17 may not benefit as much, or may see a tax increase because they've lost these exemptions. So moving on, just so that we can have the other side of this right next to it, the child tax credit is kind of the offset, like I said. And last year, under the 2017 law, the child tax credit was $1,000 per kid. It was a refundable credit, meaning if you didn't owe any tax at the time or at the end of the year, you still got the $1,000. So under the new tax law, that amount has been increased to $2,000, but the structure of it has changed just a little bit. Now, a maximum of $1,400 may be refundable. So if at the end of the year you don't owe tax, you can still get the $1,400 back. If you do end up owing tax, then your tax can be offset up to 200,000 or 2,000 per kid. Sorry, 200,000. I wish. And then for those who have dependents over the age of 500, there is a $500 non-refundable credit. So that's kind of the offset to losing your personal exemptions on those dependents that you may have had. That there is a credit that's non-refundable. So those who owe tax will get the benefit of that. One other big change that's probably the most beneficial to a lot of our clients is that the phase out of the child tax credit has actually been increased. In 2017, once your income reached 110,000, they start to phase out your child tax credits, and you wouldn't get them. And then the more money you make, the less you get until you got none. Okay? Under the new tax law, that phase out doesn't start until 400,000. And so the change there will be a lot of our higher income taxpayers will start seeing those child tax credits popping up on their return, where they haven't seen them ever before, right? Because they've just been not available because of the phase out. That this in the tax planning that I've done this year already, this is one of the things that's helping our clients out the most, those that have a lot of kids but are higher income, because they actually are able to pick it up. So moving on, the next section we're going to talk about is the itemized deductions. There's a lot of changes to itemized deductions. And so there's a few slides here, but the first one, starting at the top of Schedule A, basically, which is the itemized deduction worksheet. Medical deductions, the income threshold was dropped in 2018 to 7.5. So that means if you've had a lot of medical expenses, you will be able to start deducting more quicker. But this is only going to last 1 year. In 2019, it bumps back up to 10%. So the planning idea here would be if you've got medical expenses that you have not paid, they become deductible in the year they're paid. So you could choose, if this is a deduction that would benefit you, and you can pay the deductions this year, you get more of a benefit by paying them this year than waiting till 2019.
That's still a pretty high bar, 7.5% a year.
Right. So it's hard to meet, but if you've got major medical deductions or expenses, and you know you're going to pay them, and you can choose the timing of the payment, this is the year to take them. So, the next big change, this is one a lot of people will probably run into. There's been a limit put on the amount of state tax paid that is deductible. This includes both real estate taxes and your state income taxes. So you got to add those together, and the limit is $10,000. So for some people that that have had this deduction in the past, it will be a change that will need to be calculated in as you're doing your tax planning. If you don't normally pay more than $10,000, you probably won't feel it. So the idea or the tax planning piece on this one is if you do pay more than that in taxes, or if there's a chance, if you're right around that 10,000 mark, we'll want to make sure you pay at least 10,000. Never pay under the 10,000. Moving forward. So the commercial would be deductible in a business type return, probably, unless it's something just held for investment, like a raw piece of ground. Usually that does show up on your Schedule A, and so deducted. The next big change, again, one that probably affects more of the higher income taxpayers, is the limit on mortgage interest deductions. Prior 2017 and prior, if your mortgage loan was over $1 million, then a portion of your mortgage interest was limited. That limit threshold has been reduced down to $750,000. So this is temporary through 2025, but this could affect you significantly if your loan balance is in this range. And the $1 million amount is grandfathered in. So if you've had a loan over $1 million in prior years, you still follow that law. But if you refinance and it ends up being more than your original balance at the time of refinance, it bumps you down into the $750,000 limit. So as you are considering refinancing, if you're in this situation, come talk to us so we can do a little bit of planning to help you avoid losing this deduction. Another thing to keep in mind is home equity loans. Some of those could be deductible, and some of them are no longer deductible. The only way mortgage interest is deductible for a home equity loan is if the proceeds are used to improve the residence that the loan is on. If you use the money for any other reason, then the interest is not deductible. So that's a big change this year, that we'll probably be asking more questions about home equity loans when you send us the paperwork on how much interest you paid.
Well,
yeah.
what if I take out a home equity line and invest that?
Okay. So the question is, if you take out a home equity line and put the money into a business, is that deductible? The answer to that is yes. There's an election that we make on your tax return that makes that deductible in the business. Basically, you take that interest expense a different way than on Schedule A. Moving on to charitable deductions. what has changed. So the amount you can give to charity and cash deductions has changed. It used to be limited to 50% of your income. They've raised that now to 60%. So small change there. Don't know that it will affect a ton of our clients, but the other big change that we've seen is in prior years, a portion of amounts paid for college athletic seating was deductible, 80% deductible. Starting 2018, it's no longer deductible as a charitable deduction. So, that would be one to think about as you consider buying those tickets. Probably won't change anything, but next, casualty losses. Not one we see a ton, but it's nice to have when you do have a casualty or theft loss. Those have been eliminated between 2018 and 2025, unless you are in a federally declared disaster area. Those are still eligible. So keep in mind on that. The last section of itemized deductions is the miscellaneous itemized deductions. All these have also been temporarily suspended. Those who are going to be hit by this the most are those who have high unreimbursed employee expenses. So if you drive a lot and don't get reimbursed, or you spend money traveling and don't get reimbursed, those are no longer deductible. Also, if you have significant amount of investment expenses, payments to financial brokers, that type of thing, financial planners, those deductions have gone away. A couple other big changes.
Can I throw out a tax planning idea here?
Sure. Yep.
Sorry.
JW's got a couple ideas he wants to share.
I think this one's a big deal, so I wouldn't normally have stopped Will, but on the unreimbursed employee expense elimination, there's a couple thoughts. I see this a lot with salespeople who are traveling, right? They don't get reimbursed from their employer for certain things. I see it a lot also in certain financial insurance and other industries. But the play here is if you guys have any employees that you may not be reimbursing for their expenses, it's a win-win situation from an employee and an employer point of view to sit down and say, why don't we reimburse you for those expenses, but we'll lower your salary so compensation's the same. Does that make sense what I'm saying? So money flow is the same going to the employee. It's just some of that would be going to them as tax deductible reimbursements. So that's something to think about. The reason it's a win-win is because the employee, now his W-2 is lower and has to pay less tax. But also, as an employer, you're also benefited because the W-2 is lower, right? Because you have to pay less payroll tax on that. So one way to keep these unreimbursed employee expenses from being not deductible is reimburse them. So Mike Jones says, is there a maximum reimbursement? And the answer is no, as long as what you're reimbursing them for is a legitimate business expense, right? So cell phones, we should be reimbursing them for, or mileage, vehicle expenses, or maybe some home office expenses, or travel and meals, all those kind of things, rather than the employee paying out of pocket and deducting it on their return. Just reimburse them for those things instead and lower salary. So that's the one thing that I wanted to talk about.
So big change in alimony coming in the future. This isn't necessarily going to affect us in 2018, but is coming after 2018. Alimony payments will no longer be deductible, and or when you pay it, it's no longer deductible. When you receive it, it's no longer income to you. So divorce decrees prior to 2018 will be grandfathered in, so they'll be treated the same. But for those who may be dealing with divorce in the next year or so, this may be something to consider as you are negotiating the division of marital assets and how that works. There's some very large traps that you can get yourself into if you don't understand how this can affect you. One person could be, although it may seem like the treatment is even on paper when you divide the assets, when you start calculating in the tax effects of that division, it can be a very different story. And this just adds to the complexity. So something to think about if that's a situation you're dealing with or in the future. Yes, we did say that, yeah, divorce decrees prior to 2018 are grandfathered in and will be treated the same. So, not something that, yeah, it's going to affect you if it's already in place, but if looking into the future. Another change, moving expenses are now no longer deductible. This is another one of those temporary ones. It does not apply if you're a member of the armed forces, but it may affect you if you're looking at, changing jobs, or if you're an employer looking to recruit someone and bring them in from out of your normal location. We were in a tax training yesterday, and the government and a lot of the big corporations are already working into the compensation plan this change. Those most affected are going to be probably those that are in small business. But something to consider if you're looking at moving in the future, or if you're being recruited, or if you are recruiting, this may be something that will have to be factored into that change. So.
Yeah, so this is one of those things that no longer qualifies for tax deduction.
So it's not deductible to you as the employer. Yeah, so. And the next change, for those who have money set aside for their children in 529 plans, there was a change on how you can spend that money. You're now allowed to use it for tuition to elementary schools and secondary schools rather than just college. The maximum distribution is $10,000 annually. So yes, so you can take the money out earlier if you want. I know some states' plans are managed better than others. So if you find you got money in a plan, state-sponsored plan that's not doing well, maybe there's an opportunity there to get the money out before it's all gone. Or you do have the option to take it out whenever. Say that again. Okay, so the question was, what's the benefit of a 529 plan? So there's a very small state tax credit that you get immediately. But basically what it allows you to do is put the money in there, and the growth is tax free. So when it comes out, then you don't have to pay the tax. What is sorry, what? For the credit? Yeah, off the top of my head, I can't remember exactly, but it's very minimal. I mean, most of the time we see the credit being like $50 or $70 when they put in like 1,200. So. Oh. So I mean, yeah, you could do it to get the small. Could do it to get the small tax credit, and whatever growth would happen between when you put it in and when you took it out, right? But I don't know that it would be much benefit other than that. So, all right, I'm going to turn the time over to Bryn to finish up the individual tax section.
Okay, I think, can you hear me? Everything good? Okay, so I get to talk about the Affordable Care Act. So beginning in January in 2019, you will no longer be penalized for not having health insurance. So what does that mean to you? You don't have to have health insurance, right? At least not, you're not going to be penalized for it on your taxes. Let's go to the next one really quick. AMT. So who in here knows if they were subject? Oh, yeah. Yes. So the question was, will we still be penalized for 2018? And the answer is yes. So it's still in place for 2018. 2019, it's gone. So AMT. So who in here knows if they were subject to AMT last year? Raise your hand. Or a few. Anybody? Anyone? JW was? He's like me. And if you're,
A lot of people probably weren't.
yeah, you might have been and not been aware. If you're at home, raise your hand because I can see you. No, I'm just kidding. I can't. Creepy. I'm just teasing. So So the question is, what is AMT? So AMT is basically a different taxing structure. It's calculated at the same time that the regular income tax is calculated, and you have to take the higher of the two. So there are some things in AMT that you're not allowed to deduct that you normally are allowed to deduct on your ordinary tax return that you probably usually see. So they do have an exemption, which is similar to like itemized standard deduction type thing. And that's what this is talking about, that the exemption increased from 80 to 100. It was like 85, I think, up to about 110. But the bigger thing, and this is going to affect a lot of people, you used to start to become subject to AMT when your income was about 160,000. But now it's up at $1 million. So it's going to be a big jump. A lot of people that were subject to AMT are no longer going to be subject to AMT. So you might see a decrease from that you weren't aware that you were paying. So there's that. Any questions on that? Did that make sense, what AMT is? Okay.
It stands for alternative minimum tax.
Kitty tax. So kitty tax is if you have a dependent or a child under 17, 21? 21. They're getting unearned income. So like interest income, dividends. A lot of times this is from like, hey, I started a family partnership and I'm trying to distribute some of this income to my kids' tax rates, right? And that's what kitty tax was for. So in the past, when the child was reporting this income on their tax return, they actually had to report at the parent's tax rate. And that has changed. Now it's at the estate tax rate, which is worse. So if you can see, I don't know if you can see that, but the first $2,500-ish is 10%. And then up to the next 7,000 of that is 24%. And then it pops up to 35 for the next 3,000. And then once you're over 12.5, you're at 37%, which is significantly higher than if it was at the parents' tax rate in the past. So that's something we definitely have to be aware of and consider as you're paying kids. Net operating losses. So in the past, if you had a net operating loss, you could take that loss back 2 years. You can make an election, take it back 2 years, and then carry it forward 20. So you could get a refund immediately, right? So, excuse me, that has changed. And you used to be able to offset 100% of your taxable income to bring you down to 0 for that year if you had it. Now, you can no longer carry it back. It has to go forward, but there is no time limit, and it can only offset 80% of your income. So it won't eliminate all your tax. Roth conversions, recharacterization. So if you were to convert to a Roth, in the past you would be able to recategorize that and basically reverse that. Now, once that's done, you can't undo that. Once it's converted to a Roth, it is a Roth. So that is something to be aware of. As you make those decisions, it's more permanent. Any questions about anything? And if you have questions at home and you're watching, you can type them on. We are watching you. The gift tax? So the max is 15,000 for 18, right?
If you don't
Want to report it, right?
It's actually, I can look at it. I think it's 15. I'll look at
Yeah.
it exactly. It is indexed for inflation, but over your lifetime you can get this full 11 million, right? Yeah, but if you don't well, do you guys generally understand how this works? Are you guys interested in hearing this, or yeah?
Okay, so J-Dub's going to talk a little bit about gift taxing.
So the general concept is that you can gift up to $11 million per year per spouse, right? So like 22 million if you're married. If you you basically have to track those gifts over your lifetime. If you gift less than, I think it's 15 million, we can look up the exact amount per year. What's that? Sorry, 15,000 a year. Then you don't even have to track it, and it doesn't count towards your 11 million. Okay. If you give a large gift in a year, say you give a child $100,000, then $15,000 of that's excluded from the reportable gift, but you'd have to report $85,000 of a gift on a 709 gift tax return, and that 85,000 would eat away at your 11 million. Okay. And then so the concept is you can give away 11 million during your life or after you died, okay, but not more. And so when a person dies, they file a 706 tax return that says, here's how much I've already given away. This is how much I have left, and this is the net worth of all of my assets. And as long as we're under that, whatever's remaining, then we have no tax. So even if we file a 709 every year because we went over the 15,000, we still don't have to pay tax on it. It's just eating away at our 11 million annual or lifetime exclusion. Okay. Right. So the Will just pointed out a great point. So the big change is it used to be 5 million, and it used to be not indexed for inflation, really, and now it's they moved it to 10, but then indexed it for inflation. Okay. Yes, a question. How much of it gets, so a question is how much does it get clawed back? Oh, here's an interesting fact. You're right, it's changed. It changes a lot. I've practiced since 1997, and when I first started practicing, it was 800,000. And so the question is, will that 11 million ever be reduced? It might be. We don't know like what legislation's going to do, but I can tell you over the last 21 years, it's always gone up. And if you go look historically, it has never decreased, except in one situation. Do you guys know the one situation? There was 1 year it was unlimited. Remember the unlimited year? So there was 1 year they just said, it's unlimited, but then they actually brought it back. But when they brought it back, it was higher than it was two years before that. Well, this is just my opinion, but my opinion is that it would be grandfathered, just like everything else that you see is grandfathered. General tax policy from the legislature is constituents get really ticked off if you take away a benefit you already gave them, which is why Obamacare didn't get repealed, which is why Social Security hasn't been repealed, right? So generally speaking, if they change the law and it's more detrimental to the taxpayer, they'll usually grandfather situations that have, taxpayers who have already taken advantage of the laws that existed at the time when they made the decision. That's per child and per parent, right? So really, if you're married and you're gifting to a child who's married, that's really 60, right? Because each parent can give 15, and then you can also give to spouses. So, question? Okay, we have a question from. Okay, so the question is, if you have a prior year net operating loss carrying forward, is it going to be limited to the 80% limitation? I don't have a great answer for that. Does anybody know? We probably need to research and send that out. My guess would probably be wrong. My guess is that it's probably yes. It would be limited. Can a spouse gift to a spouse is another question. And the answer is yes. A spouse can gift to a spouse, and there's no limitation. Like a spouse could give 100 million to another spouse, and there's no gift or tax, situation on that. Yes.
So it seems to me like this money that we might be gifting, money that we've already taxed on ourselves. So now it's just trying to avoid paying tax.
Right. So the question is on this gifting discussion that we're having, the money that we would be gifting, yes, has already been income taxed. So the tax that we're talking about now trying to avoid isn't an income tax, it's estate tax, right? So the estate tax basically says if you die and you leave more than $11 million to your heirs, then you'll pay roughly 50% of the excess to the government. And so that's a whole separate tax law, not really having to do anything with income tax. But that was changed this last year. Do you guys have any other questions on any of the topics that we covered today? Yes. So property taxes. So the question is, has the law changed with property taxes and mortgage insurance, right? Mortgage interest. So now I know your situation. So you're probably thinking, did I restate the question adequately? Okay. So you're probably thinking, in your case, I own a bunch of properties. Is my mortgage interest and my property taxes going to be limited on the properties that I own? Is that the way you're framing the question? And the answer is, if we're talking about rental properties or business properties, the interest and the property taxes has not been limited. Okay, it's only been limited on personal properties that you own, your personal home. Okay, or personal investments. Like if you have a second home in St. George, then that falls under personal properties. So yes, mortgage interest is going to be limited to the 750 on new acquisitions. It's grandfathered if you already had owned properties. Okay. And then property taxes on your personal properties is now lumped in with state income taxes that you pay and deduct, and you can't deduct more than 10,000. That's the limit when you fill out your Schedule A to decide if you're going to itemize or not. Does that answer your question? You have a limitation on personal properties, but not business properties. State income tax is lumped in with the property tax, not with the mortgage interest, but you combine your personal property tax and your state income tax together, and those you cannot deduct more than 10,000 in a year. So a lot of people are being impacted by that. Most people are paying more than 10. So the question is it possible to rent your own house and make it, so we're trying to say, hey, let's make this a tax deductible if we're over those limits. The answer is yeah. I mean, people rent their own house all the time, but you're limited by, you have to keep track of how many nights you rent it to someone else versus how many nights you use it yourself. And then you can take, the proportion amount. Because then your home does become a rental. You have to fill out a Schedule E, the rental schedule, report the rent that you collect on your house so that you can deduct. So the question is, okay, so can I create an LLC, put my house in it, and rent it to myself? Yeah. You can do that. It's probably not advantageous to do that because you do have to pay a fair rent, which becomes income to yourself. So they usually wash. The other problem with having your LLC own your home is you would no longer qualify for the 5-year, 2 out of 5 year, $500,000 exclusion. So you're kind of disqualifying yourself probably from that. Which, by the way, was threatened under the new legislation, but survived. We're all happy about that. Yeah, if you sell your personal home and you've lived there 2 out of the last 5 years, you do not have to pay tax on gain up to $500,000 of gain if you're married, half of that if you're single or married filing separate. That's a huge tax benefit. So with the appreciation we're noticing in Utah and how prices are, going up, we probably really want to save that exclusion. So, any other questions? Yeah. Mm-hmm. So alternative minimum tax. So the question is, did I hear it right that you don't have to worry about AMT unless you make more than $1 million? We always have to consider AMT. Okay, we always have to run that. So it's almost like you got two formulas. We have the normal formula that We know, well, we take our income, we subtract mortgage interest, property taxes, charitable deductions, and apply the rates that we showed you, and that's formula number one. Formula number two is alternative minimum tax. It has a flat 28% rate. You can't deduct any state income taxes or any property taxes. Anyway, there's a whole different formula, okay? And there's a standard deduction, we call it, that you take under that formula. And that standard deduction was like 85 grand. It's now 110. And that amount, that exemption amount, that standard deduction under AMT used to start going away, start getting reduced when someone made 110,000 of income. Okay. So by the time you made like 200 or $300,000, that 85,000 deduction that you got against AMT was gone. Now that 110 that was 85, now you get 110, doesn't start phasing out till you make over $1 million. Okay, so it's still possible to pay AMT if you make less than $1 million, but since that phase out doesn't get reduced until you're making $1 million or more, and because the deduction is higher, you're just not going to see a lot of people paying AMT. We used to see people pay AMT between what? Probably between $250,000 to $400,000, maybe $200,000 to $400,000 of income. We saw people pay AMT. Well, if you think about the exemption, if the exemption's $1 million, or sorry, 110 now, that's a fourth of it. And we have that phase out at $1 million. And if you look at the rates, if I were to slide back, the scale or the slides, and we looked at those rates, by the time a person makes 400, 500,000, they're already above the rate of 28%, right? So you're just not, you still might see some AMT, but my guess is that you're probably going to see AMT in situations where, in normal situations where their income is maybe 500 plus instead of 200 plus, right? Or in situations where another one of these add backs in AMT are employee stock options, right? So, I mean, there's a million scenarios. I don't want to bore you with them all, but you see AMT a lot when somebody has an ISO, an incentive stock option. They go to Adobe gives them some stock, but it's qualified and it's not taxable till the sale under an ISO, but yet it's taxable under AMT immediately. So lots of things to know about, but anyway, probably more discussion than you wanted about AMT, but maybe that helps put it in context. Yes. So in the gift tax, if we exceeded the 11 million, does the recipient pay the tax? Okay. So the question is, if I receive a gift, do I have to pay tax on it? And the answer is no. The only person paying tax in a gift situation or an estate situation is actually the donor if he exceeds those limits, or she. So, okay. So Bryn did some research on the NOL question. What did you find? Okay, so it's grandfathered. Should have fell back to that answer, right? So if you have a net operating loss carrying forward from prior years, it's going to be able to continue to offset 100% of the income going forward. Only net operating losses starting in 2018 going forward will be limited to the 80%. Same grandfathered concept. Okay, so one more clarification on the NOLs is that the old NOLs have a limitation. You can only carry them forward for 20 years, and under the new law, they're unlimited in time length that you can carry them forward. Do you guys know what we're talking about? Net operating losses in general. You guys want some clarification? I'm happy to give it. Basically, it's if you have a business loss that exceeds all of your other sources of income. Any other questions? You guys want food? Okay. All right. Sounds good. We'll go on break here for maybe half an hour, have some lunch, relax, take it easy, and help yourself. Some counties. I've got
They have to agree.
All right, we're gonna get started. So we're hopping into the business changes now. You're gonna hear from me again for a minute. So first thing is, unlike the individual changes, most of the business changes are permanent. They don't expire like a lot of the individual ones did. Corporate tax rates. So they used to be on a graduated schedule similar to the individual tax rates and how that's taxed, but not at the same rates. But they did make it a flat tax now for corporations, C Corps, and they're at 21%. So if you have a C Corp, that could mean that you're paying less this year, depending on what kind of income you were bringing in. Corporate AMT. So we talked a little bit, you guys now understand what AMT is. And unlike the individual AMT, it's been repealed completely. So it's no longer going to be in effect for corporations. And I think we're gonna, if there's no questions on any of that, we're gonna have Dustin hop in here. He's gonna talk some depreciation.
All right, now we get to talk about all the fun stuff. So bonus depreciation. Most of you in here, I think, are business owners or have rental properties, things like that. So a lot of cool stuff happened with depreciation in the tax law change. So the biggest one with bonus depreciation is, it used to be that if you bought something new, you know, it had to be brand new to kind of the world. So you go out and you buy something new, you could take 50% of that in the first year, and it's what we call bonus depreciation. So you bought something for $100,000, you could get a $50,000 depreciation deduction. So that was the old law. That's gone away. So now we can take 100% in the first year, and it doesn't have to be new, just has to be new to you. And they actually backdated it to, I don't know why they chose September 27th, but that's the date they chose. Yeah, why not choose September 27th, right? And so it went back. And so a lot of you probably, if you bought properties or you bought fixed assets during the last quarter of the year, you probably realized some of this bonus depreciation that we're talking about here. And so why is this good, or how is it going to affect you, is basically now anything that you purchase, we can deduct in the year. So it's pretty big deal for most businesses. We used to do a lot with Section 179 depreciation, which is the next. Oh man. There we go. So Section 179 depreciation is what we used to use a lot, because this was the one that you could use for used equipment or used items. But the problem with it was it had limits. You could only take up to 500,000. It capped out at about 2 million. Once you had capital purchases of more than 2 million, you couldn't take any more Section 179 depreciation. Section 179 depreciation laws did change as well. They moved it up to 1 million. So now you can take 1 million in Section 179. And the cap also went up to 2.5. So what does this all mean with these two different types of depreciation? Basically, we can write off a lot of stuff, right? So if you buy anything or you're looking to invest and build your business with capital expenditures, we're going to be able to take a lot more deductions than we were able to in the past. So pretty awesome thing. You don't have to buy it outright. You can finance it and still take the deduction. So it's a pretty cool thing that has changed. It will help a lot of businesses on their tax.
100% depreciation is it prorated depending on when you buy it in the calendar year?
Nope. So you could buy it on December 31st and you could take bonus depreciation of 100%. So
For example, if you bought a real estate property, is that subject to depreciation schedule now still, or is that 100%?
So the question is, if you bought a real estate property, is it subject to bonus depreciation or does it have its own depreciation schedule? And the answer is kind of. It depends on how we treat that real estate property. If we did a cost segregation study on the property, there would be portions of it that would qualify for bonus, and then there would be other portions that would not. So yes and no. If you just left it as a real estate property, it would be subject to its normal depreciation rates of either 27.5 years for residential or 39 years for commercial. But if you did a cost segregation study, then we break it up into the smaller assets, the different useful lives. So this is so bonus in section 179, that's a good point. They're subject to qualifying property, which is basically between 5 and 15-year useful life property.
Is that also for rental property? Rental properties?
So yeah, same thing. If you did a cost segregation study on it and you broke it up and said, instead of calling it just a rental property, you broke it up and you had your fixtures and your furnishings and the equipment part of it. Yeah.
People that rent, like a house.
Yeah. So yep. So same thing, because you can choose to do a cost segregation study and break it up from one asset that's a house to like 20 assets with different useful lives. But if you don't do the cost segregation study, then it would be just the section. So then it would be just year. Yep. Yep. On a rental property.
Bonus on the 27 year.
Yeah.
You still need 27.
So it's 1/27th basically of the purchase price on a rental property you can take in a year if it was a residential. Yep. Yeah. So the question is, what type of assets would be subject to bonus depreciation or section 179 depreciation? So yeah, like equipment. You go out and let's say you have a landscaping company and you go out and you buy a big bulldozer that's 150,000. You could write the whole, useful life is 5 years. Write the whole thing off in the first year. So it depends on the useful life of the asset. So basically the main two that don't qualify are real property as far as like a commercial building, the piece of that that's considered commercial property that's 39 year. And then they've changed a lot of stuff with the tenant improvements. So some of that stuff is been moved to 39 year and different things like that. But typically what we're looking at is equipment, furniture, new computers, vehicles, that kind of stuff. Yes, they are. Let's see, I've got a slide in here. Okay. It's a little out of order, but so the question is about vehicles. So the answer is yes, there's still some restrictions on types of vehicles, but now they have changed the depreciation to where it's increased first year for just a regular vehicle up to $10,000, and then you can get bonus of 8. So you could take, 18,000 on a vehicle where before we could used to take like 4 or 5.
That's on a vehicle less than 6,000.
Yeah, and so that's on basically any vehicle. So that's vehicle less than 6,000 pounds. But if you, the same rule still applies if you buy a vehicle over 6,000 pounds. So if you buy like that fancy truck over there that's over 6,000 pounds, you could depreciate the full thing in the year. But if you get the sweet Tesla down in the corner, then you're subject to the 18,000 and the rest of the useful life. But the rates have gotten a lot better. So with vehicles, you can take a lot more depreciation than you did before. So, you know, like with your question about the 6,000 pounds, that was one thing that we used to talk about when you come in, you do tax planning and you're like, I've had a great year. What do I need to do? And go buy a Ford F-150 and you're going to save, you know, so much money in your taxes. And now there's a lot more liberty on which vehicle because you're going to get a better deduction. So, all right. Okay, so this is a big thing that changed with meals and entertainment. So entertainment is gone. No more deduction for entertainment. So it can still be a business expense, right? You could still have your business pay for it, but you can't deduct it on your taxes anymore. So what is entertainment? It's like going to the golf course, going to the jazz game, those type of things, right? And meals, so all meals are now subject to 50%. That doesn't matter if you're traveling, doesn't matter if it's meals with an employee, doesn't matter if you're taking, you know, a client out to lunch. All meals are now 50%, which is a change because if in the past, if you were to take your employees or you brought meals in for your employees, it used to be 100%. No longer. So that's kind of the change around meals and entertainment. So just one thing to be aware of, one thing you might want to look at in your accounting is if you are paying for some of these entertainment type things, just have it be a separate line so that if you were to be audited by the IRS, we hope no one ever is, but if you were, you could let them know, hey, look, I'm aware of this rule. I've broken out entertainment separately and I'm not deducting that. Yep, your business could still pay for it, but you just won't get it deducted on your taxes. Yep.
50% meal rule for 2018 and 2019. When did that?
So the question is the 50% meal rule for 2018 and 2019? So the answer is it went into effect January 1st, 2018, and there's no end in sight for when that changes. So
Hard to handle per diem.
So
you don't actually have the counted meals, but traveling, so you see, how do you do that?
So the question is, how do you handle per diem? And with that, there's some specific rules around per diems that are different. And so depending on how you're paying the per diem and what guidance you've given the people, it may be added to their W-2. It may not. And so because they want it backed up by receipts, essentially, right, to get the deduction. So for the business owner, if you just wanted to give a flat per diem of, let's say, $50 a day for meals, right, and they can go do whatever they want, right, then the business owner would still get that deduction. It is possible that the employee could have to pick that up depending on the specific circumstances.
So can I comment really quick? So I'll just comment on that. Are you guys familiar with the per diem rates published by the government? You go Google it, you can say per diem rates, and it'll take you to, I don't know, I could go look it up, but it'll take you to a website. And per diem rates allowed by the government, it's gsa.gov travel, and you can look it up by location. And these are intended for overnight type expenses, lodging and meals specifically. So if someone goes out of town on a sales trip, you go to this website, you look it up, and it says, you know, Los Angeles, and then it gives a fixed amount. And you can pay employees those amounts, and it's not taxable to them, doesn't show up on their W-2, and it's a deduction to you as meals or as travel. Okay. So that's the strict definition of per diem. But there's a concept generally related to that that's different though, and it's let's say it's just what's the word I'm looking for? I'm going to give you an allowance. Okay, let's say I'm going to give Bryn a $500 vehicle allowance. Okay, that's different than per diem, right? So allowances, they have to be either under an accountable plan, like kind of Dustin was alluding to, or if they're a non-accountable plan. A non-accountable plan means Bryn doesn't have to account to me how she spent the money. If it's a non-accountable plan, the $400 going to Bryn gets added to her W-2 and she pays tax on it. I pay all the payroll taxes associated with it. It's payroll. If it's an accountable plan, meaning Bryn has to report back to me, here's my receipts, here's where I spent the money, then that's not taxable to Bryn. It doesn't go on her W-2, and it's just an expense on my books for whatever I reimbursed her for. So that there is a difference between allowances, accountable, non-accountable, and then per diem. So they're kind of all in the same genre, but treated differently.
Randy from our at-home audience watching on the webinar just wants to know, are credit card statements acceptable as receipts? I find that most receipts are printed on thermal paper that just fades to nothing over a few months. What's the best way to document my expenses?
Okay, so question online basically says, are my credit card receipts enough documentation for the IRS? Because the paper that I print just, fades away. So in an audit situation, I've been in this situation actually, and the technical rule is that the credit card statement is not sufficient because it doesn't show what was purchased. Okay, so for example, Walmart, $150. What it doesn't prove what I bought at Walmart. I could have bought donuts for the day for everybody because we love donuts at Davies Allen, or it could have been paper, right, for the office. Now, I'll tell you this. So that's the technical rule. I'll tell you this, though, in audit, what I experienced was it depended on the vendor. So, for example, if I had a credit card receipt and it was to Guru's restaurant in Provo, it's pretty obvious. Like, there's one thing I can buy at Guru's, it's lunch, dinner, meals. Where the credit card receipts didn't work is like the Walmart example, or Costco, right? Or places where Amazon, right? Places where you spend money and that just doesn't really document well what you purchased.
Now, they can take a photo of that receipt, right?
Yeah, and we don't need to keep physical paper. We can scan that in a PDF and save it, or we could take a photo and save it. So we can be efficient in our filing systems, and we don't have to have paper, but we do have to be able to show the IRS receipts.
I'm sorry, the per diem thing applies to my employees and contractors a lot, like the actual per diem when we go out of town or overnight. So just to verify one more time on that, if I'm using it in the actual per diem sense and I follow the federal guidelines of the amount that we give, let's say I paid for everybody's hotel rooms, but I give them the non-hotel rooms, just the meals part of that per diem. When I give them that money, either as a contractor or as an employee, do either of us have to, how do we claim that so that it's?
So if you're using the actual per diem rates specified on the website that matches, then you do not include that in their W-2, or you do not include that in their 1099 even. And you just write it off as travel costs. Okay. Which is very different than if you just give someone $100 and say, here you go, here's the hotel for the night. That's kind of non-accountable. But if you're very specific and you look up Phoenix, Arizona lodging, and it says that's the rate and you pay them, then you're you're in the clear. You don't have to even report it or worry about any of that.
Quick question on. So, as an example, not deductible. Buy my stuff through it.
So the question was, we might still spend money on entertainment as a business. We'll just throw it in the expense into the entertainment category, and we'll just pay taxes on that portion. The answer is, yep, that's correct. So meals and travel are deductible, but the entertainment piece is not. So like, if you meals are 50%. So yeah, so a Christmas party, I would tend to lean towards that as more of like employee fringe benefits type of thing versus entertainment.
Now, I know your kind of parties, and if there's some kind of payment to some crazy entertainer, you know what I mean?
For instance, we're gonna do a casino night. So I'm
Yeah.
paying to have a casino, come in, bring the facility. How does that land?
We're gonna figure it out.
We're gonna like have a grant.
Right?
Yeah.
So you're saying that an expense, you write it as an expense and add it back to income at the end of the year?
Yes. So
Or do you just keep a separate category to say this was entertainment, but then you don't take it as, okay.
So the question was, we'll keep the entertainment expense on the books, but we'll just add that back to income when we file the tax return. And the answer to that is yes. Yep. All right, interest deductions. So this is something that changed. So now for the business, if they have interest expense, they can only take up to 30% of the adjusted taxable income of the business as a deduction. So what does that mean? That means that for some of these maybe startup companies that are very heavily leveraged, have a lot of interest expense, they're not going to be able to deduct it all. They're going to be capped at 30% of the taxable income. Or if you were in a position where you were maybe at a loss for the year and you had a bunch of interest expense, you wouldn't get to take that deduction. So there is one exception to that. If you are considered a qualified small business, which they have changed the limits on that up to 25 million a year in revenue, you're exempt from it. So the rule doesn't apply. So a lot of small businesses this won't affect, but a lot of big businesses that have more than 25 million in receipts, this is where they're going to get hit with this interest expense deduction allowance. So
Justin, sorry, we just have another audience question.
Okay.
Kind of related back to this. If you pay your employees to come to the Christmas party, is it deductible as a company?
So the question from online was, if you pay your employees to come to the company Christmas party, is it a deductible expense? And the answer would be yes, it should go through their payroll, just like your other normal payroll. Yep. They got just like normal payroll, right? So if you're paying them via payroll, right, it's just going to be a payroll expense. Same rules apply for payroll. All right, we already got to see this cool slide. All right, so this is a big deal. Qualified business income deduction. So what this says is that 20% of the income for a majority of businesses out there, when it passes through to the individual, won't be taxed at the individual's level. So if you make $100,000, 20,000 of it won't be taxed. Okay, there are some rules around this. Certain service providers get excluded. Accountants are one of them. We didn't lobby hard enough or something, I guess. There are some limits. So if you are under 300,000 on your personal income, and you're a service provider, you still get to take the deduction. There is one caution if you're over the 315,000. That is that you are subject to 50% of wages. So what that means is if you have wages, you've got to pay wages to be able to get the deduction. So the purpose of this is to stimulate the economy in the US, right? Hire people in the US, manufacture, do those things in the United States. And so what that means is if you, let's say, for example, your business makes $1 million, but you only, and so 20% of $1 million would be 200,000, but you only have 100,000 in wages, you're only going to get 50,000 in the deduction because you only get 50% of the wage. Okay. So this is something that if you have a lot of income, but maybe not necessarily a lot of wages, that you should get with us and talk about so that we can make sure you have enough wages to get the full deduction, because 20% is still better than the 15% of the payroll tax. So this is a really big deal to stimulate the economy. So yep. And so what this replaced was what was called the domestic production activities deduction. So it used to be 9%. So it basically went up to 20%. And it was very specified into which companies or types of industries qualified. So manufacturing, construction, those type of things used to be the only people that could get it. Now it's opened up to most businesses and even the service providers if they're under the $315,000 threshold. So DPAD is gone. So domestic production activities deduction is gone. It's replaced with the qualified business income deduction, and it's basically doubled, a little more than doubled. So
You have $5 million in income, $5 million, you have to have $2 million in payroll to be able to take that full thing.
yep. So if you're under the $315,000 limit, you just get the deduction, right? So if you're under the $315,000 kind of exemption level, you get the 20% kind of regardless. Doesn't matter what industry you're in, doesn't matter what wages, those type of things you pay. But if your income is going to be over that, that's where it comes into effect. Yeah. So the question is, it's going to be essentially your EBITDA. So it's going to be the amount that flows through on your K1. So your ordinary income that's coming over on your K1 is the amount that they're looking at. So.
Give me some examples of other service. Financial advisors.
Yeah. So the question is, what are some other service providers that are not allowed if they're over the 315? So financial advisors, I think attorneys, doctors, yeah, dentists, healthcare professionals are not. Athletes. So
Consultants. It doesn't say
yeah.
insurance.
Yeah. So it doesn't specifically say insurance. Consultants are included in that amount or in those industries.
It does say financial advisor.
Yeah. It does specifically say financial advisor.
So I was expecting a bunch of cheers on that one. Like, this is huge, dude. I don't know if you guys, I mean, we're kind of going through slides and whatever, but like, if we have like some way to measure, like, this is a cool slide, this slide sucks, like, that was a cool slide.
So for you at home, JW just mentioned that this was a cool slide. So, because it is actually a very big deal. It's going to save a lot of business owners a lot of money in taxes that they're going to go do good stuff for the for the country, the economy with. So it's a pretty big deal. I probably should have put the "it's a big deal" picture on the other slide with Ron Burgundy, but this is a pretty big deal as well. So capital gains used to be, if you had capital gains from anything but the sale of real property, there wasn't a whole lot you could do about it. You just were going to pay the tax. So what happened is, as part of the tax reform, they came up with what they called opportunity zones. What happened is President Trump gave all the governors the charge and some direction to go pick 25 opportunity zones in their state. And what the idea is that if you have a capital gain, can be any type of capital gain, could be from the sale of stock, could be from the sale of a business, could be from the sale of real estate. Any type of capital gain that you get from selling an asset, you can now put those gains into what's called an opportunity zone fund. And you create your own fund. It's a partnership, a corporation, whatever you want it to be. And you fill out one form and you send it to the IRS that says you designate yourself as an opportunity zone fund. Rules are a little bit similar to 1031 exchange. You've got to put the funds in there within 180 days. And then from that time, you actually have another 180 days to get the property that you're going to develop. And what the purpose of these funds are is to go into these opportunity zones and to develop something. It could be you buy raw land and you build a new building on it, or you buy an existing building and you fix it up. But what is super cool about this, and this is why I put this as kind of a big deal on this slide, is that if you hold on to that property for more than 10 years, you never have to pay tax on those original gains. They're just gone. So that's pretty awesome. And actually, it starts at 5 years and starts to slowly phase up. So this is, if you are thinking about selling a business, or you've got a lot of stocks or things like that, this is a very big deal for you to understand. And it's very new. Like we didn't get the zones out until June. So there's not been a lot done with these yet, but they're putting out more and more information every day. We do know where the zones are. We have the maps, those type of things that we can share with all of you. But this is a really big deal if you have any type of capital gain. So any questions about opportunity?
Commercial building, sell it for a gain, capital gain on the exchange. The asset you buy also have to do like property person, like a box or name.
So the question was, if you sold a commercial property that you held in an entity, and you put the funds in, then how does that work? Can you then own the fund personally, that type of thing? So my understanding of it is that the entity that's contributing the money, that's deferring the gain, that would be the one that still owns it. But you don't have to go and buy another commercial building. You could go buy, like you said, raw land and you could develop it into single family residential homes or something different. So it doesn't have to be the same asset type to same asset type. It just has to be in the opportunity zone.
But the fund has to own it.
Yeah, the fund. Yeah, so the opportunity zone fund will own the property.
The other cool thing about these opportunity zones, you guys, so the other cool thing about these opportunity zones is that it doesn't have to be real estate. Like you could put this money in your opportunity zone fund, and you could start a new business that's located within that opportunity zone. Okay. So, and if you go, we can actually share with you guys the link to the map that Dustin referred to earlier. But you can go look, and there's opportunity zones in Salt Lake, There's some in Provo. I mean, they're all over the place. And really the purpose of this is to try to what? Rehabilitate those areas? What's that? So the question is, but it still has to be real estate. You can't use the funds to buy a business. And the answer is no. Like, it doesn't have to be real estate. So you can, this is like 1031 on steroids. That's what this thing is. Like, this is like being able to do a 1031 on stock. Like, we've always had all these years, we've had gains on the stocks, and we've had nothing to be able to do to shield those stocks from gain unless we go sell a loser stock or have another capital loss somewhere. But now we can take those gains from stocks or real estate. We can put it into a development fund that can develop real estate, can develop a business inside this opportunity zone, and defer the gain or potentially exclude the gain, like just eliminate the gain. Oh yeah, you can. There's opportunity zones across the whole country. They're just designated by the governor of each state. So each governor had the opportunity to choose those zones. So it's a big tax planning deal for us. It's like, this is like I said, 1031 on steroids. 46 zones in Utah. Yeah.
Yeah, so this is, like Ron and Burgundy says, this is a pretty big deal for tax planning. And if, where I see a lot of value that could be added for something like this is if, you've grown your business and you're ready to do something different and you want to sell your business and maybe you want to get into real estate or something else, this is a perfect opportunity for that. So maybe that's why they call it opportunity zones. I don't know for sure, but it's a very big deal, something to be aware of if you have any type of capital gains for sure. So kind of going along with that is like-kind exchanges. So it used to be we could take our truck, trade it down to the dealership, trade it in, and we do a like-kind exchange and only, have the new asset for just the difference, depreciate it going forward. Can't do it anymore. So like-kind exchanges now only apply to real property. So any tangible personal property no longer counts for a like-kind exchange. So not a huge deal, but something to be aware of. So as far as like-kind exchanges go, a lot of what we see with this would be vehicles. People go and trade in their vehicles, and they would defer the gain on the trade-in of the vehicle because they'd taken bonus or Section 179 before. So you can't do that anymore, but now you can take more depreciation on the new one you purchased. So not a huge effect on that. And I guess if it was a big enough piece of personal property like stock that you had a bunch of, you can now put it into an opportunity zone and defer all the gains anyway, which before you couldn't really do much with it. So that's just a little bit of information on like-kind exchanges. So 1031s are still in effect for real property. So you can go land to land, or, real property still works for like-kind exchanges, but no longer for personal property. All right, so accounting for businesses. One of the big things that changed is if your business made over 10 million before, you had to do the accrual method of accounting. If you had over $1 million in inventory, you had to account for your inventory, all these types of things. They've kind of simplified it all to where if your business makes less than 25 million a year, you can just do cash method, and makes it a lot simpler, right? You only pay the tax when you get the money in versus doing accrual. So makes it easier on the reporting side for taxes. There still may be some business reasons why you would want to do accrual accounting so that you could match your revenues with your expenses and those type of things. So you could see what your true margins are, that type of stuff. So But for tax purposes, we don't have to do that anymore for a majority of businesses. Go ahead. So the question is, even if you've already converted to accrual because you were over the limit before. So my understanding is, yeah, you could convert back because you're no longer subject to it. You can go back to the cash method. So yeah, this is just kind of trying to simplify things for a lot of what is now considered a small taxpayer. And so then this one on excess business losses, this is a little bit tying into what Bryn talked about before with net operating losses. And basically before, if you had a big loss in your business, you could roll it through to your personal and eliminate all of your tax. But that is being limited now to 80%. And it's because this ties in with those individual laws. And so in the past, we've been able to take all these business losses that we've had and just really not pay any taxes. You're going to still get a lot of it, but it's going to be limited. You're going to have the NOL that's going to carry forward. But you're going to be limited to that 80% you can take moving forward. So go ahead, Ortex. So the question is, what if you show a loss after depreciation? Works the same way. So, because what they're looking at is that number that's coming over on your K1. And so that has depreciation factored into it already. And so you could still, let's say, for example, you had $300,000 of income from W-2s and other businesses, and then you have one business that's got a $500,000 loss. So that's going to come through, and on your individual return, they're all going to kind of net, but you're not going to be able to take the full 500 and wipe out the other 300. You're only going to be able to wipe out 80% of that other 300. Okay. So those are kind of the new exciting changes in the business side. Like Bryn mentioned earlier, one of the best things about this is that they don't have an end in sight like a lot of the individual ones do. So there's a lot of cool things that happen for business owners to change how they're taxed and to really control what taxes they pay. So any questions anybody has? So the question is, what about state sales tax for online purchases?
So friends are funds expert on multi-state sales.
Okay, so probably I'll start with kind of what you're referring to. Previously, the state sales tax for online sellers was subject to what they call nexus well, not previously, but still is, physical presence. So you had to have physical presence in a state to be required to collect and remit sales tax. Things that created physical presence was having an employee there, having a building there, sometimes having like a salesperson, depending on the state that's selling for you, even if they're a contractor, would create that. But in July, end of June, there was a court case in South Dakota, and it was with Wayfair. So if you don't know, Wayfair is kind of like an Amazon type thing, but for furniture and home goods and that kind of stuff. And the judge basically said, you know what, in this day and age, you should be able to collect and remit taxes pretty much everywhere, right? So the rules that South Dakota had and the rules that kind of the thresholds that went through the case were if you had $100,000 of income in that state within the last 12 months, or 200 transactions in that state. So those two things, or one of the two things, would create sales tax nexus in that state where you then had to collect and remit. Now we are waiting because every state has to make their decision. It didn't basically overturn everyone's ruling, and now everyone had to comply with that because every state makes its own policy there. So a lot of the states are defaulting to the South Dakota rules. There are a few that haven't even said anything yet. Texas is still doing physical presence until late 2019. I have a list, pretty comprehensive list of all of the details, but some of them put that into place as of July 1st of 2018. This was like a lost revenue stream to a lot of states because of how online sales has exploded, right? So it wasn't that the tax was getting paid in a different state, it just wasn't getting paid at all. And so it was revenue that was being lost. So that is something to be aware of if you have an online store.
So what would be how would we take the number of transactions per day trying to figure out what our actual liability is? And then you can go through state by state and say you're above, you're below, and apply whatever one state.
So the question is basically, how do I go about determining where I need to file? And basically, you're correct. I've had people send me the reports from their sales system that shows amount of sales and number of sales. And I go through and I tell them, well, this one you're subject to as of this date, or you need to get this in there at this time. This one hasn't ruled yet. We're still waiting for ruling on that. This one's rules are still, and they have no intent of changing, anything like that. So yeah, you have to go state by state. They do have a streamlined sales tax system. I don't know if you've heard of it. There's, I think it's 26 states, if I remember right, that are on it. And you can sign up for, like, basically you register once and it registers you for all of those states. I've been looking at that. The ones that I've been looking are running numbers for people. They would have to set up 20 states that they don't need for the 6 that they do. So, but there is that option if you just want to, do that. But there are also some obligations if you're going to create a sales tax account that you have to register in the state, which creates a whole new set of issues on tax filings as well.
Yeah, because once you register, now you have to report.
Yeah. So JW says once you register, then there creates a reporting issue. I saw a hand over here.
Yeah, I was just wondering what period do you count? You start like new sales from 2018 or is it just a month or how many?
So a lot of them are the last 12 months. And when you become obligated, then you have like 60 days, but they're not going retroactive. So if you were obligated in 2017 or something like that, people aren't going to come, like, you're not going to be in trouble. You just need to get it ASAP and start collecting and remitting that.
Okay, so last year you still have more than $100,000 in selling this state, but who's say that next year you're going to have, like, if you register, then yeah.
Yeah, so the, I guess, comment / question was, let's say last year you made a ton of sales in Arizona, which you don't have this year. Well, you're registered. Exactly. You're registered, so you have to keep filing and paying. There are some, and I expect more programs coming out that will track it for you, talk with your sales system, that kind of stuff, because sales tax rates can change quite frequently as well, so you have to keep up on that. So
I have a question.
yes.
So sales tax rates can vary by community. For example, in Utah, the sales tax rate in Heber is different than it is in Salt Lake. And it's probably different, maybe even by zip code, potentially. So if I'm collecting sales tax online, is it just a matter of a rate in a state, or do I have to know the exact rate of the locale of the address of the customer that I'm selling to?
Right. So the question is, in some states, there are, like Utah, the tax rate can change by specific location. And so do I charge the same rate across the board? Do I charge per location that it's being sent? And the answer is where it's being sent. And so it can get super complicated. Now, like Idaho is a flat 6%, right? So sweet, you just collect 6% across the board. But Utah, if you aren't located in Utah, you've probably already been reporting here. But if you sold to someone in Heber and then you sold to someone, I don't know, down in St. George, you have two separate tax rates, and you've got to collect and remit on those rates and track it and report it. So it can get really complicated. So any other questions on that?
Maybe comment on the type of businesses that would be subject to sales tax. Is it just products or other types of services?
Okay. So JW said to mention types of businesses that are subject to sales tax. I mean, the most obvious one obviously is retailers selling products, personal property. Some states actually tax labor and services. And then I don't know if you're familiar with, software as a service. You probably have a lot of those subscriptions, but there are some states that tax that as well. Utah is one of them. And so the seller of that should be collecting and remitting tax as well. It really just varies state by state. It depends. Utah's laws are a little complicated because it depends on what you were doing with the labor. Like if you were installing something onto like real property, then no. But if you were fixing it, then yes. That makes sense. Like fixing personal property, sorry, then yes. So
like a mechanic.
Right.
Would need to charge sales tax.
Correct.
But an accountant does not.
Does not, no. So a mechanic, yes. An accountant, no. That's what Jada was saying. So, any other questions on that? Did I just bring down the mood?
Just a question, sales tax related. It's a question from our audience on the owner 20% pass through that's subject to the 50% of wages. Are the owner's wages included in that 50%?
It is my understanding that it is. The question was, are owners' wages included in the wages to calculate the 20% deduction limitation? And yes.
So how does that play into tax strategy before year end? If I am a small business owner, I may be the only employee. I think Randy Leiniger, is participating. He sent me an email. He has this specific question, right? Like, I'm the only employee. I've got good income this year for my business. Do I need to be increasing my wage before year end? And the answer is, if your taxable income ends up being less than $315, no, because you're not subject to that 50% wage limitation. But if your taxable income is above that, then absolutely yes. So one thing we're doing for the first time, like that I can remember in 20 years, is actually telling people their wages should be higher. Right? Because all these years we're telling people, keep your wages on the pessimistically low side of reasonable so you don't have to pay the payroll tax. But now in certain situations, we're saying the benefit is actually better by raising your wage to make sure you hit that 50% hurdle and paying a little bit extra payroll tax to get that 20% deduction. So I've run the numbers. And yeah, there are definitely clients that need to be raising their wages before year end. Now, I'll make one more comment because Martesh is probably sitting over there saying, crap, like I don't have a lot of employees, but I have a business and it has net income and I'm investing in real estate, right? There's another hurdle that we haven't talked about, but it's a similar qualifier to like wages, and it's basically, what is it, 3% of capital investments. So if I've got, am I right? Is it 3%? So if I've got $10 million of property, then what's the math on that? $30,000. Okay. So that would also be a limitation as well. So that would be a similar limitation as the wages. Okay. So even if I have zero wages, I could still take up to a $30,000 qualified business income deduction. So it's wages, but there's a second option you have, which is 3% of your total capital investment into your business. Okay. All right. Anybody else have any questions? Anything at all?
Randy does want to know what your favorite tax evasion or planning strategy.
Oh, I'm sure he does. Yeah. He wants to incriminate me publicly. Yeah. Yeah. You know what? One thing we haven't talked about today is captive insurance. And captive insurance is one of those topics. It's a tax planning idea, but it's one of those topics that is really interesting. It takes more time to discuss really than we have now, but I could lay out just a couple details. It's a way that you can self-insure business risk. So you can go create your own insurance company, a C corporation, and then you can identify risks within your business that you could self-insure. And then you could, and you have to hire a captive insurance manager, and it costs like 20 grand to set one of these up and like 20 grand a year to maintain it. So it's not cheap to do. So it's not a fit for everybody. But for somebody who can identify business risks and can justify actuarially that premiums would be, say, 150,000 a year or north of that, then you start justifying the costs of setting it up and maintaining it. But it's like a 401k on steroids, to be honest with you. Like so the way this works is my business pays my insurance company, and my business gets a deduction for the insurance. And under code section 831B, the insurance company does not have to pay tax on those premiums. Okay, so I get a deduction, no income to the insurance company. I'm just growing this huge nest egg. The problem with a lot of clients is it's still a $150,000 hurdle that, you have to be able to put in that. But if you could afford 150 or more and have business risk to justify it, captive insurance is one of the best ways that I know of right now. Besides cost seg, besides paying kids, besides a lot of these other things we've talked about today that you can really save some money. I will say though that captive insurance is like on the IRS dirty dozen list. And the reason is because a lot of people have misused them. They haven't used them properly. On the other hand, I'll tell you like that the Larry Miller companies and several other big companies here have their own captive insurance. So if you do it right, it's legitimate. It's just that it's like this. I'm a Vivint salesman, right? And I make 500,000 a year because I'm really good at going door to door. I don't have any employees. I don't have a product. What's my business risk as a Vivint salesman? I walk up to the door and I get bitten by a dog, and that might not even be my risk because I'm going to sue this guy, or whatever. So I really don't have risk. but I set up my captive and I pay 200,000 into it that I deduct. So the IRS just doesn't like it when people set up these captives that aren't justified. So, Randy, maybe that's an answer to your question there. But I like captives, yeah.
I imagine that they're not going to look as favorable on us during our own risk as they would with
So are you from the point of view of your vendors?
we start looking
Yeah.
our ability, our bank wants to go with that fire insurance.
Yeah.
So I want to know that, if somebody gets our products, they have requirements, right? $1 million,
Yeah.
$2 million umbrella policy, whatever. You address those.
So the question is, there's a lot of third parties that require us to get insurance, right? Not just for our own purposes, but relationships that we have require us to get insurance. Are those relationships going to think favorably if we're self-insuring or not? I don't know. I mean, maybe not. But I will say this too, that with captive insurance, it is not intended to replace your current insurance. So most of my clients that I'm meeting with that adopt captive insurance, they're keeping their current insurance in place. But what we're doing is we're looking for additional business risks to ensure that aren't currently insured. So for example, loss of a key client, loss of a key employee. I mean, let's say I have a business I'm running and I've got one customer who's generating 50% of my revenue. Okay. I mean, that's not uncommon. Can I go insure that? I mean, if I walk into, State Farm, right? Can I insure that? Probably not. If so, it's very expensive because there's a huge risk there. So we're looking for risks that are there, but yet we're not going to be insuring probably elsewhere, and because the premium would be so high anyway. But now we can justify that risk and pay it to ourselves. So that's kind of the way it's used.
That's one of my questions. Let's just hypothetical setup. Start paying it. It's big enough now that account's sitting at $3 million.
Yep. So we set it up, we get a lot of money in there, that account's sitting at $3 million. Okay.
Right. We got to pay the $20,000 maintenance.
Yep.
No
Yep.
matter what. Can we now have that captive insurance company take over our liability policy?
So at some point in time, could it take over our liability policies? And the answer, I think, is yes. And I mean, we could seriously have a whole seminar on captive insurance. But I do want to just tell you the exit strategy really quick, so you kind of see the in and the out. Let's say we've got this captive insurance policy or this captive insurance company funded now. We funded it for 10 years. We've got $30 million built up in this account, right? Or whatever, 2010, whatever the number is. Now we're like, I don't need it anymore. I sold my business. I'm ready to retire. What do I do with this money that's in the captive insurance company? Well, we can shut it down. And it's a C Corp. So when we pay dividends out of a C Corp, how's that treated? You guys know? Long-term capital gain rates. So it's not like we've got out of the tax, but in essence, what we've done is we've deferred it for 10 years or whatever in this example. And we put it in and we got an ordinary deduction at 37%. Now we're taking it out and we're going to pay 15%. So that's kind of the long-term strategy, is the, saving the delta between the two and deferring. So any other questions, you guys? Ready to call it a day? Everybody's looking at your watches, your clocks. You're saying, let's wrap this thing up. Okay. Well, appreciate you guys coming. Thank you so much. We really appreciate all you do.
Thanks for those of you that tuned in online with us. If you're still on, if you'll do me one favor, if you'll just go to Davies Allen card.co and then go to this feedback area. It's just right here, and just leave us some feedback. We'd love to hear from you. Thanks for tuning in.